Hey everyone, my name is Daniel and welcome back to another video. I hope all of you are having an absolutely phenomenal day out there. As always, Discovery stock is up upwards of 25% over just the past 2 weeks as momentum has really shifted for this company. In this video, I want to talk to you all about exactly why Discovery has gone up so much over the past couple of weeks, whether I'm still bullish on it at these prices, and exactly what I'm doing with it in regards to my overall portfolio. So if you end up enjoying this video and potentially even end up finding some value in it, please consider subscribing. And with that out of the way, let's get into it here, guys. So here we have it. This is Discovery stock trading at $28.50 after hours here, and you'll see that again this stock did bottom out at around the $23.50 range, in and around there at the end of October. Now, I made my original video kind of October 22nd, October 23rd, when the stock was trading at around $25 per share. Now, ever since then, I've been buying pretty heavily, but obviously momentum's changed in a massive way. And as shareholders, the first question that we should have is, why did the stock go up so much, and is this move justified? So in this video, I hope to answer that question to all of you. So what we did have, and this is probably the main reason as to why the stock went up so much, Discovery reported earnings about a week or two ago, and long story short, they were pretty dang good. I just want to go through some highlights here. They did report right around $3.15 billion in revenue, growing 23% year over year, pretty much in line with analyst expectations. Now, the actual incredible part comes from international growth and international networks, which saw a revenue of $1.3 billion, 44% growth year over year, and the US network growing by 12% to $1.86 billion. Again, I look at Discovery, I see potential there over the long run. And again, this is just the current business. Obviously, they are merging with Warner Media, which, we're going to talk about when we go through the actual valuation of this company. But, this is kind of just the core Discovery business, which, will significantly change over the next couple of years. Results were better when we talk about net income. So we have $726 million in adjusted, they use a different metric, operating income before depreciations and amortizations, something different than EBITDA, earnings before interest, taxes, depreciations, and amortizations, something very similar in that sense. And the consensus estimate was roughly $665 million for that. So they did beat on that estimate pretty significantly. And, US was profitable, actually $963 million in, again, adjusted operating income before depreciations and amortizations, while international actually saw a bit of a loss. So that's kind of interesting. They are, with no doubt, investing into international growth. That 44% growth comes at a cost. We saw that, but either way, there was a lot of positivity this quarter. GAAP EPS, 24 cents versus the 14-cent estimate. So all in all, we look at the actual core business, it performed very well. Now, not only do we have positivity when it comes to the actual core business of Discovery, but on top of that, we got a ton of positivity when it comes to the actual potential combined business of Warner Media and obviously HBO and Discovery. When we look at deleveraging, one of the biggest risks when it comes to Discovery stock, and again, the combined business with Warner Media, which obviously owns a variety of, massive TV shows and movies, etc., is the fact that they have a lot of debt. When, they do combine, the original expectation was to have a 5x net leverage to essentially EBITDA, right? In and around there. And that's pretty significant, to be completely honest with you. And the goal was to reach right around a 3x target within 2 years. Again, going 5 times their actual earnings before interest, taxes, depreciations, and amortizations to closer to 3x, which is much more sustainable. That's the level Discovery's been at over the past couple of decades, and they've been completely fine. Also, keep in mind, a conglomerate like Discovery and Warner Media will have a very easy time potentially, increasing their capacity of debt or potentially taking on more debt if a situation, or potentially extending their debt if the situation does arise. There is power with size, and that's, again, Discovery, and one of the benefits that they do have. Now, the updated guidance calls for a 4.5 5x leverage at close and a much faster timeline to getting to that 3x. So this might be one of the positive impacts of this good earnings report. But again, you see positivity here about, hey, when we do end up merging sometime in 2022, we're going to have less debt. That benefits shareholders. That frees up more cash to be used elsewhere, potentially for, again, working on that direct-to-consumer initiative, which is their main focus, or, potentially through a variety of different ways like stock buybacks or dividends. I personally do prefer, again, them investing into their business, as, I do see a lot of potential with, again, the combined business of HBO and Warner Media and Discovery. Now, this kind of does lead me to my next point, which is cost synergies. When Warner Media and Discovery combine, there are going to be a lot of things that significantly decrease the cost between the two businesses, given how similar they are, and given how similar, when you look at HBO and Discovery Plus, how similar those two platforms are. And they did, hint, and not maybe hint, but kind of reference to their acquisition of Scripps Networks back in, I think it was around 2018, 2019. Management did highlight that at the time, they were able to cut their costs from non-content expenses by roughly $1 billion, or essentially representing 35% of all of their non-content relating expenses. Now, in the case of this kind of merger here with Warner Media, we can actually expect something very, very similar, where kind of Discovery's overall kind of savings in terms of expenses can decline upwards of over 10%, which is massive, and again shows the potential of this. And they did kind of heavily emphasize this and really did focus in on Scripps and how they managed to really flip that in a massive, massive way to really impact Discovery's business in a very positive kind of manner here. So, we'll see what ends up happening. They also acquired a lot of debt with Scripps, managed to get that to the 3x goal, which is what they're planning to do. So, the management team, they are very, very excited about this merger with Warner Media. And, I am as well, to be completely honest with you. So last thing I want to talk about with all of you, Discovery did report $425 million in revenues from their direct-to-consumer segment, which pretty much doubled year over year. So again, massive growth in this space. They expect, or rather managed to get 3 million net adds for their direct-to-consumer product, Discovery Plus, bringing their total subscriber count to 20 million, up from 18 million of the time of the last conference call. They did note that churn rates were near the best in the streaming area. Great to see. Again, people not just subscribing, but people maintaining their subscriptions. And that potentially shows the quality of Discovery's content and, the niche kind of audience that they're targeting. But in reality, there is pretty much something for everyone on the actual Discovery platform. And that will increase substantially once Warner Media does end up getting, again, merged with their business. So kind of my overall takeaway from all of this, Discovery's killing it. Great to see. Their overall business is doing great. Now, the bigger question that I want to ask myself is, hey, is this move justified? And does it still have potential over the next couple of years as a shareholder of this company? So the next thing I want to do with all of you is take you through my spreadsheet to show you exactly where I think Discovery stock price may be 2 to 3 years into the future post-merger with Warner Media. So here we have it right here. This is the actual spreadsheet. We'll see again, Discovery currently valued at right around an $18.81 billion market cap in terms of their actual equity. Now, this is at around $28.50 per share. Keep in mind, I am pre-recording this video. Now, when we take a look at, again, the debt that Discovery has currently totaling right around $15 billion, leading it to have an enterprise value of right around $33.8 billion, give or take a little. Now, we do have HBO as well, sitting at around $43 billion in debt, giving that, again, an enterprise value of $43 billion. You combine the two, you get $76.8 billion in enterprise value of the actual combined business. Now, out of this enterprise value, Discovery's getting 29%, HBO, or in this case AT&T, is retaining 71%, giving Discovery $22.27 billion in enterprise value. That is what they have. That'll be important in a moment. So these are the expectations that they're guiding for. Assumptions $52 billion in revenue by roughly 2023. Again, it does depend on the exact date as to when this merger will close, assuming that it does close sometime in 2022. This is assuming kind of end of 2023. And, the multiple, this is probably one of the more debatable topics, at least at this point. I'm going to give it a 12, and this is significantly lower than Disney or Netflix, which are trading rather in the 20 to 40 range. So, I look at Discovery, I look at HBO as a business with very similar potential to Disney Plus and Netflix, which are valued pretty highly. I think a 12 is honestly conservative and only potentially dictates upside from there. So again, I'd rather be conservative with my estimates, and I'm going to use a 12. Now this ratio right here, debt to EBITDA, I'm going to use a 3 times multiplier. Now they're guiding for roughly 2.5 to 3x by 2023. And, given the positivity that we just found out of, again, they're expecting roughly that 4.5x number by the time the deal closes, which is down from 5x. I have high confidence that they'll be able to hit this, if not potentially even go down to 2.5. But again, I want to be conservative. Let's use that 3x multiple. Now they are expecting $14 billion in EBITDA. That is assuming roughly a 27% margin in terms of EBITDA, which is a bit lower than where Discovery's at right now. So, they're being a bit conservative. We can bump this down to maybe 25%, which we'll do in a moment. Again, if we want to be more conservative, because, kind of my overall investing thesis is, hey, if things don't go perfectly, do I still make money? And if so, I want to be involved with this business and the stock. So, either way, you assume this debt to EBITDA multiplier right here, 3x, giving us roughly $42 billion in debt by the end of 2023, down from, in this case, $58 billion at the time the deal closes. So now you get a bit of an idea as to where Discovery may be trading at some point over the next couple of years. Again, using this 12x multiplier for enterprise value to EBITDA and this $14 billion in expected earnings before interest, taxes, depreciations, and amortizations by the end of 2023, we get to a potential long-term valuation of roughly $168 billion in enterprise value for the combined business. Now, taking off this debt, we get roughly $126 billion in equity. You take 29% of that, which is the part that Discovery is getting, you get right around $36 billion in equity, or in this case, roughly 100% upside in share price to potentially upwards of $50 per share. And this is being pretty dang conservative with this multiple, which I could see going to 14, 15, 16 if things do end up going very well. I think there is a lot of kind of confusion in the market, at least at this point, as to, hey, what the heck's going to go on when this merger finishes? Why is Discovery only getting 29%? And, so on and so forth. And I do think the market is kind of slowly opening their eyes to the potential that these two combined businesses have over the long run. Now, back when I kind of made my analysis and kind of looking at, where the stock was at right around like we actually take a look at where it was at around $24, $23 per share. Obviously at 24, it does have more upside, right? 130% versus 95%. But either way, I look at what's kind of going on right now. This isn't a 6-year projection. This is a 2, maybe 3-year projection looking out into the future, right? Probably not even 3 years, roughly 2 years. So you take a look at a 2x potentially over the next 2 years, that's a massive opportunity that you can't really find out there in the stock market, which leads me to my next point, which is, what am I doing with Discovery moving forward? Personally, I've allocated right around 3.5% of my overall portfolio to Discovery, and I believe in this business for the long run. Now, I'd be happy getting this up to 5%, 7.5%, but the stock's experienced a lot of positivity, and I don't want to buy into positivity. Now, does this mean I don't believe in Discovery? No, I think it's got massive potential, and that's why I hold it. But at this point, the stock's rallied 25% over the past 1-2 weeks. What's going to happen moving forward? I don't know. The market's at all-time highs. Some people are saying it's due for a pullback. If it does pull back, Discovery potentially could go down. So although I'm personally not buying because I already do have a good amount of my portfolio in Discovery shares, which are up maybe 10%. If the stock does end up dipping upwards of 5, 10, 15%, I could definitely see myself adding to my position given the positivity we just experienced and potentially making this closer to 5%. So I'm a big believer here. I think it's got a lot of potential. Let me know what your thoughts are in the comment section down below. But the biggest question of debt is starting to go away. The market is realizing this, and I think there's a lot of potential here. So anyways, thank you all so much for watching this video. I really do appreciate it. And hey, we'll see you all in the next one. Bye-bye.